Hello and welcome to the first episode of BuiltPlace's Housing Conversations of the year 2021. And thank you for joining us today, and I'm delighted to be joined by Peter Williams. And today we're going to be having a bit of a review of 2020 and also what might be happening in the year ahead. So we're going to be looking at the drivers of what was behind the housing market last year, the consequences of that, what impact government assistance has had and maybe might have in the future, a bit of a review of forecasts for both last year and this year, and then we'll obviously round up the discussion. Good morning, good afternoon, Peter. I'm used to doing it in the morning.
It's Surbiton, it's still the same time zone. Yes, good afternoon, Neil. And for everybody, we're going to have this as a conversation, but with Neil really leading much of the commentary, because he's the man that scopes so many different data sources and comments on a regular basis. So we thought we'd kick off then by thinking about the drivers. So Neil, kick off on the drivers.
So I guess the driver that is in everyone's mind, particularly estate agents at the moment, is the stamp duty holiday. And we had that announced back in the summer, and it came as a surprise to a lot of people. The timing of it was a little bit strange. There were already signs that the housing market had actually started to recover after the lockdown period. We were seeing Rightmove and Zoopla data showing activity was up, activity on websites was rising, but obviously in the housing market we deal with a lot of lagging data, so it was quite that maybe wasn't quite so apparent to people who weren't quite as fixated on the housing market as some of us. And clearly the savings there have driven a large amount of activity since then, and we're now in the midst of the rush to complete a lot of those sales that have been that were agreed since then. And there's a lot of people worrying about what happens in March, but we'll maybe talk about the consequences of that. But so clearly the stamp duty holiday has probably been one of the biggest factors, but it's not the only factor. The housing market was locked down. There was no activity happening for a couple of months back in the earlier part of 2020, and so inevitably there will have been people who either had already agreed to move house or who maybe would have been looking to move house in that period, were frustrated during that period, and so that activity has been delayed through to the year. And so when you look at activity across the whole of 2020, HMRC transactions are saying activity is down around 10% compared to the year before, and so conceivably actually just delayed activity. But there's a final factor, and this is the one that it's a lot harder to quantify at the moment, but we should, looking back in 10 years time, we'll probably have a much better idea of the extent of the activity, and that's the so-called race for space. People have been sat at home, they've been having to use their homes in different ways, either studying or working from home. There's a desire to have a shed or a spare room to work from, a garden for the kids to play in, and so people have they reassessed what they wanted from their homes. And so far there's been a lot of commentary around that trend, and there's been a lot of estate agency data and listing website data suggesting that there's been a shift in activity to larger houses, away from flats, and also towards more rural locations rather than city centres. But the actual quantifiable data on that is still fairly limited. And I guess a big part of that as well is obviously with people working from home. The home is no longer valued just as a home; it's valued as a workspace, and so there's perhaps some longer term consequences there that could play into some of the features around the relative value of commercial workspace versus residential properties.
I think I'd throw into that mix. I mean, I totally agree with all of those. I mean, I'd throw into that mix. Clearly, there's Help to Buy still as a driver lurking there, because we know the changes are going to come through in 21, or the year we're in now. And so there's been a bit of a stimulus there for Help to Buy to get closed out if you've got a transaction. Of course, there's been various transition arrangements. And then, again, one of the other ones that I think hasn't been enumerated in any great detail, but of course, people have been saving money. And one of the consequences of not going into work has been people have been accumulating cash. And certainly for those that are in work, and it's clearly all of these migration trends you're talking about, Neil, we'll come onto this, are selective. But clearly for those in work, with continuing mortgage pricing competition, with low interest rates generally, some people have had cash to add to their transactions.
Yes, I think absolutely. And there, if you look at the ONS and the Bank of England data, there was a massive spike in household savings back in the second quarter that's continued through to this year, and is likely to have been added to over Christmas and in the current lockdown. People haven't been going on holiday and eating out in restaurants to the same extent that they have, and so for those lucky enough to, as you say, be in work, it's been a very big driver. And potentially there's been people there who have moved home, younger professionals now able to work from home, no longer tied to having to commute in London, who have perhaps been able to save on rent and everything else. So there's clearly been some
And where would you put the fall in sterling and the attractiveness of the UK as an overseas buyer's destination in this? I mean, it's a very selective part of the market. And we obviously have data on the relative outflow from the UK rather than inflow. But these are second homes, not permanent residences necessarily. But would you see that as quite significant as well?
This is probably the first time I've been asked this question since I worked for an estate agency company, so I can perhaps answer it slightly differently than I may have done in the past. It will have played a part in certain markets, and I think the additional stamp duty for overseas purchasers that's due to come in this year will undoubtedly have had an impact. Combined with the stamp duty saving, I wouldn't be surprised if, particularly in those markets where developers of new build homes are, do a lot of selling off plan overseas, there's been a rush to complete those to both gain from the current holiday, but also to get ahead of the new additional stamp duty rate. And so I think that will have played a part. But I think its effects on the national market will have been limited, but it will undoubtedly be quite significant in more local markets, central London, perhaps new build markets in other city centres, areas like Manchester. And I guess there's one other part of that we still don't of international demand that we don't know about is the Hong Kong visa question, as to how many people from Hong Kong will decide to move over. Clearly it's a very large number. I can't remember the numbers off the top of my head that could in theory apply for the visa. I think the numbers that suggest they might move is in the hundreds of thousands, but I wouldn't be surprised if a large proportion of them already actually own property in the UK. So the actual net effect may not be quite as large as
100,000 at one point.
I don't think it may not be quite as large as some estate agents hope.
Yes. So, I mean, we've run through the drivers there. Let's go on then. And what we still don't have really is any weighed analysis, which really picks out the relative effects of all of those. They're all in a kind of mix at the moment, I guess, Neil. Would you go with that?
Yeah, I think so. And I think clearly the stamp duty holiday ending
is the big one.
Currently due to end at the end of March. That could be a big, from a data analytics point of view, that could be quite interesting as to what happens after the market to help guide us to the relative balance of those drivers.
And we'll also take out Help to Buy in terms of the rush for the current version. So 2 factors out of our 6 there will come out. We'll begin to get a better picture as data's released of what some of the other ones will be doing.
Yes.
Okay, let's go on to talk about consequences. So, okay, we've got these drivers. What can we see about their impact on markets nationally, locally, regionally?
Well, I mean, the first story that appeared to emerge following the market reopening was this kind of the race for space, people looking for larger properties outside of urban areas. And it does look like there's been a relative decline in the number of flats being sold across the market. The data's only just beginning to get through the land registry transaction data. We're probably now only really knowing what happened properly back in the autumn. And it does look like there have been some shifts, but the ONS house price index out the other week showed that actually house price growth seemed to be rising across the country as a whole and across all property types. I do have some questions about that and the fact that the data's on quite a small sample size. I estimate the November index is probably only around 20% of total transactions that actually occurred in the month. So we may see some revisions there. But
but I mean, the ACA data, sorry to cut in, the ACA data certainly highlights a decline in flat sales in prices in certain locations, and the opposite of that, if you like, the rise in detached. But the numbers are still quite problematic, certainly for the last quarter of the year.
Yeah, I agree, and I think one of the important things to remember is also if people are selling up and moving out of London, that still means there's a buyer there to buy the home off of them in London. And the interesting question there will be, who have those buyers been? Are they homeowners? Or I have a suspicion, and it'll take a while for the data to come through, that investors have been taking advantage of some of the current market conditions.
That's certainly the evidence that Hamptons have put out, as you've seen. Certainly does suggest we've seen a slight rise then in landlord activity vis-a-vis first-time buyers. So I think the circumstantial evidence supports that. I mean, these moves out are clearly quite selective, aren't they, Neil? Not everybody can afford to move out. Not everybody has a job that allows them to move out. A lot of people, perhaps those watching this podcast, might even be tempted to think it's normal, but actually it's a fairly selective world we're talking about here.
Yeah, and housing market turnover has been, it's a very low proportion of total housing stock. I can't remember. I don't know if you have the numbers off the top of your head, Peter. 4 or 5% maybe. I want to say of owner and investor owned property, and so we were averaging around about 1.2 million transactions every year before the pandemic, out of what, 19 million privately owned homes, 20 odd million total
and that
homes.
Was down on the long historical trend.
Yeah, and so that was down on the pre-2007 levels and well down on the 1980s levels. So turnover was very, very low. You're only talking about 100,000 people transacting every month, and so it doesn't take very many people to decide that all of a sudden actually we do want to buy. We're looking at an extra 20,000 people every month, and what we're seeing there is the impact of that on the market. So the illiquidity of the housing market is a big factor, and we know from reams of papers and data and evidence that the housing market has become increasingly concentrated amongst those who are both higher up the income distribution but also the wealth distribution, and it's especially true for first-time buyers, but it's similar right across the buyer activity groups. And
in that sense, this recent trend probably has further exacerbated the wealth inequality effects being expressed through the housing market. The real differentials, this will have widened some of the gaps that exist.
Yes, unfortunately, I think that was probably the only certainty that we knew about the future when we went into the pandemic, that it was going to widen the inequalities in not just the housing market but also the economy generally. And unfortunately, that's what we're seeing. We're beginning to see quite a lot of evidence now that the pandemic itself is affecting people who live in more deprived locations. Young people, lower income people have been more affected by furlough and the economic fallout of that, and also we were talking just a minute ago about the increased savings, and there's evidence there showing that again it's higher income, wealthier people who have been able to increase their savings, and people lower down the income distribution have been less able to, or even seen a fall in their savings. And so clearly we've got a wide spectrum of what has happened here, but it does look like wealthier people have become wealthier and poorer people have become poorer, and that unfortunately has wider consequences. But with regards to the housing market, it widens people's ability to access home ownership or not.
And in terms of the geography of this, clearly, as you were saying, the race for space, we've seen markets, say in the southwest, outside of London, in the east. London's been the loser, I guess, in this process. Places further from London have been the gainers. Wales has been has seen a fairly lively market. How do you see the geography of all of this?
Well, clearly there's been an urban effect just due to the pandemic, and at the moment during lockdown, a lot of the reasons why you'd want to live in a highly dense urban location just don't exist. They're all shut down, and unfortunately, it looks like some of these places may take quite a long time to recover from that. But ultimately, I think the longer term futures of cities will be secure, but it could be quite a long time for some of them, and. There's a question around the impact of working from home, and clearly for some people it works really well. I think the kind of the average impact is actually, I quite like it, but I do also quite like being in the office. So I think we'll see a lot more flexible working, and maybe working 2 or 3 days a week at home and 2 or 3 days a week in the office, and that obviously that has an impact where it enables people to stretch out their commutes, and all of a sudden sitting on a train for an hour and a half when you're only doing it 2 days a week is much more palatable than if you were doing it having to do it 5 days a week. So we'll see some places like that, but I think one of the big consequences of the inequality is very much that we'll see, and this is maybe slightly jumping ahead, so I won't say too much, but we'll see places where people want to live, where people are, desirable locations, be it for their, maybe desirable rural areas or on the coast, or they offer specific, facilities or amenities, or, good schools or whatever, will become and remain more desirable, whereas those locations that are places where maybe people have to live because it's the only place they can afford, or because it's close to their place of work that they still have to actually physically go to, may struggle. And then you add in the consequences of perhaps the economic consequences of the pandemic and Brexit, and maybe that might then be another layer on top of it.
Yes, I mean you're quite right. There's a fairly complex geography going to emerge from all of this that's going to take a while to consolidate, isn't it? But there'll be a clear picture of a pattern of change. Some people talk about it almost as if it's a temporary change, that actually one of the consequences, yes, this is the immediate reaction, but once jobs are back, offices are open, people will revert to previous patterns. I'm certainly not of that view. I think there are genuine changes here for the long term, and I think that's your view.
Yeah, I think so. I mean, it's clearly difficult to read exactly which ones will be permanent and which ones are short term, but I think perhaps the ones that are more likely to persist are those that actually we already had hints of in the first place. The working from home revolution, it's been ongoing for a long time now, and it's even within my career, the attitudes in workplaces has changed, and I think we'll see more flexibility going forward. And then even things with we mentioned the flats and their decline in sales, and actually the market for flats has been declining since 2016, when the additional stamp duty was brought in for investors and second home buyers, and actually it's been slowly declining ever since then. And we've Help to Buy equity loan has driven a shift of new build activity away from flats towards houses. And so actually that's a trend that if you look at the data you can just about see it emerging, and clearly the pandemic has exaggerated it. So I think it's those kind of, it's where the pandemic has exaggerated or accelerated the existing trends. I think those will perhaps be the ones that are most likely to continue.
And then the feed through, Neil, do you think, into the rental market? Because obviously there's an investor market, there's a rental market. Clearly we've seen some changes in the rental market, decline in rent, certainly central area rents seem to be under pressure because of people moving out. Are you seeing other trends on the rental market?
Well, I think that's perhaps the biggest one, and it's perhaps the most fascinating one, because normally during a recession you actually see and a housing market collapse, you see the demand in the rental market increase, and certainly we saw it back in 2009-10, where we had the credit crunch and first-time buyers were excluded from the market, and a lot of young people, you see it when you look at student numbers, a lot of young people decide to stay and study for longer, maybe take on a master's, a PhD, and so it for all sorts of reasons you see people staying in the private rented sector for longer. And so normally you'd expect growth of demand for that. And we will be seeing some of those effects at the moment, but it seems that the pandemic, being a very different crisis to a normal economic one, a lot of people, rather than staying in their flats, people have been moving back home with friends or family. Clearly, this year, this academic year has been terrible for higher education students, and the impact that they're feeling, and having to pay for rent, and the student housing providers have been struggling with low occupancy rates, so that's had an impact. And the big unknown at the moment that's driving a lot of debate is what's happened to non-UK born workers. And there was the paper the other week suggesting that the number has fallen by around 1.3 million, and
yes,
the authors of the paper present that number as very much an estimate and a possible outcome of what could happen, and hopefully the ONS is looking in more detail as to what will happen. But a side consequence of that is that the census this year is going to be very, very interesting, and rather frustratingly from an analytical perspective, it's actually what's the relevance of it with regard to the long-term trends. But
clearly we've had all the Airbnb property coming back into the rental market. I mean, inevitably we've had the commentary from landlord organisations that large numbers of landlords are going to exit because of this. I suppose the question for both of us is, where are they going to exit to? Because there's still an issue about what other assets are going to give them the returns that they've had through a rising housing market.
Yes, unless they're keeping an eye on Reddit message boards to find out which stock to invest in, then that you're looking for alternative assets that generate the returns that residential do. Certainly in your higher yield markets, it's unlikely that, and also just the ability of people to leverage up in the residential market is one that's far greater in other financial markets. And so there's a slight question of, well, where are you going to go, and who are you going to sell to? And ultimately the house doesn't disappear if the landlord sells, so it's still going to exist as a home for people. And so I think some of the concern over that may be a bit overdone, but
that would be my instinct.
Yeah, I suspect that the challenge, the bigger problem there might be the longer term consequences of the stock in the private rented market. We already know that in general it's much poorer quality than the social rented sector and the owner occupied sector. And so if returns are falling, if rents are falling, and maybe house prices aren't going up to the same degree that they were, and landlords are feeling poorer, there may be less incentive there to invest in the stock, albeit that is being slightly counterbalanced by by government policy.
And Richard Donald makes the point in the FT last weekend. I think he calls it the funnel effect of people households forming or whatever, coming into the private rented sector, flowing out then as first-time buyers. That if we reduce the flow into the private rented sector, that may itself have an impact on the flow through into home ownership.
Yes, and one of the big factors this year has been the credit crunch affecting first-time buyers. The reduction in the availability of higher loan-to-value mortgages, and also the increase in the mortgage rate on them, so they cost more, and added lending criteria around them. You need to show you've saved the deposit yourself rather than got it from your family. And I talk about first-time buyers, but it's affected other people. Self-employed people are finding it harder, but broadly, mortgage availability has been constrained for first-time buyers, and so that is going to limit their ability. And so we're going to, so far, and I don't know if you've got more up-to-date numbers than me, but so far first-time buyer numbers have held up. Yeah. But as Bob Pannell suggested the other day on Twitter, clearly first-time buyers are becoming even wealthier and higher income than they were this time last year, and so we're seeing a lot of those inequalities be exaggerated in who's accessing home ownership. So the numbers may hold up, but the important thing to look at there is the distribution, and I think that's probably a point across all housing market data.
Which, while we're talking about, is where, in a sense, if the Bank of England is going to review some of the stress tests, they ought to think about the segments that it impacts in that way. Let's go on, Neil, to talk about government assistance, because clearly looming over the whole market and a big debate by the market in a degree of self-interest, I might say. The market has been arguing for the continuation, or at least a short-term continuation of stamp duty, and for a continuation of Help to Buy, always arguing that more assistance is needed to avoid a cliff edge in the housing market. Where do you see government assistance going?
Well, I think the challenge with extending the stamp duty holiday is that even if you do extend it, you're still going to see the cliff edge effect and a fall away. And we saw that during the last recession. They actually extended the stamp duty holiday for 3 months, and we still had the cliff edge effect and a fall away. So that's going to happen irrespective. And if they extend it now, it's, whether it's a month or 3 months, at that end point, we're still going to see a spike in activity. It might be that the timing of that spike is better if we're into a point where vaccines have actually had an impact and the economy is reopening. So there is perhaps some argument there. I do wonder. I'm slightly mixed in whether they should do it or not.
I think I'm fairly clear in my own mind that they shouldn't.
Yeah.
For a start, I think we've effectively seen stamp duty savings capitalized into prices anyway. I think it may have been a timing issue even about when stamp duty holiday was introduced, but because the market momentum, as you said earlier, was there partly because of lockdown and the pent-up demand. So the market was going to move a bit anyway. Did we need the stamp duty holiday? We've had both. So I personally think we should cut it off now. The sense you get, the mood music inevitably from government is always, we're not going to do it, because they always say that until they do.
I think I would generally be with you, but if they are going to do it, and this may not even be possible, is they need to be much more selective about who they're extending it for, rather than just a blanket extension. They should do what they didn't do last time and exclude investors from it, for example.
Well, that's what Wales, of course, has always a progressive force in terms of housing policy. The Welsh government excluded investors from the stamp duty holiday, and I think that was a very wise move.
And so, I think if we do extend it, that it should come with some conditions like that to hopefully take some of the heat out of the market. And you mentioned Help to Buy there, and clearly there was the kind of the very subtle extension of the completion deadline the other week through to March. And I mean, ultimately, the replacement Help to Buy will cater to the majority of demand. Because most users of the existing scheme are first-time buyers, and house builders have had a long time to deal with the regional price caps and refocus where their activity is going to happen and what property type. So they've had plenty of awareness for that. It may be sensible if they need just to help get some of the remaining completions over the line under the current scheme, extend it, but I don't see that being a particular issue in the wider market.
Those price caps are going to bite, aren't they? Because I mean, clearly, it's allowed some relatively affluent people to buy some fairly expensive property. I mean, the slogan that Help to Buy is bigger, better, sooner, is actually says that quite a number of users it's been a discretionary choice, that they've chosen to use it rather than they had to use it, and it has given them leverage to buy bigger properties in better locations rather sooner than they might have done.
Yeah, just the use of regional price caps is a bit strange as well, and not least as we've just been talking earlier about the local impact of of housing markets, and so you would have thought something a bit more granular would have been possible, but the help to buy bigger sooner is. It's both a plus and a minus of the scheme. At the very least, we know that these people who, even if they do end up in, if there is a crash and they end up in negative equity, as long as they're able to service the mortgage, they're in a home that is big enough for hopefully their long-term needs. So I'm far happier about it being that than a rush to overpay for a small, one-bed flat or studio.
No, I agree.
So there's at least that positive about the market. But when you look at all of the stats about housing delivery, it is an incredibly important supporter of housing delivery at the moment. And so with these changes and the underlying economic conditions, it could be a tough time going forward. And I think housing delivery last year looked to be about 40,000 homes fewer than normal in England. So that's more like 200,000 a year rather than 240, 250,000 we had been seeing. And that raises questions about the government's target. What is the government's target exactly? Is that they may be hitting it at 200,000, but there are it's going to be a challenge. But I think a lot of house builders have been proactively engaging with the challenge, and so we'll probably see a shift towards more 2 and 3 bed houses rather than the 3 and 4 that we had been.
I mean, because the other one that sort of loomed into view, I guess, more recently in terms of government assistance is the fair taxation issue. The sort of request by the Chancellor in the middle of last year for the officials to start looking at property taxation again, in the round, council tax, etc., as well as stamp duty, capital gains tax. I suspect you, like me, would probably take the view they may well look at it, but it's unlikely that we'll see anything emerge on that.
Yeah, I'd agree there. I think it's politics first, isn't it? And you have a very high turnout group of older voters sitting in their homes that they own outright that are worth in aggregate quite a lot, and on an individual basis to some people quite a lot as well. And any attempt by the Chancellor to tax that will not be taken lightly by those homeowners.
What about on landlords? Because clearly over the last 4 years we've seen a number of government moves which you might say are against the landlords. Could you see that going further?
That could be the one possible area. And interestingly, one of the points that's missed around the government's idea of increasing the availability of 95% loan-to-value mortgages, hidden in the original paper, there was them suggesting ways to counteract the inflationary effect that would have on house prices. And one of the ways is to first incentivize landlords to sell to first-time buyers. Yes. And if that doesn't work, you then tax them. And so that is there hidden within the 95% loan-to-value mortgage policy idea, which was in the manifesto, and Boris Johnson mentioned, I think it was back in the autumn again. And so it's in there, and so it may be that landlords do find themselves targeted once government's attention returns back to helping first-time buyers.
Just on that note, I noticed a parliamentary answer around government actually helping people in the housing market by long-term fixed-rate mortgages, and which Boris Johnson made quite a lot of in a speech just late last year. But the parliamentary answer that was given by Mr. Pincher was the government stands ready to work with the market to encourage it to develop longer term mortgages rather than the government taking any initiative itself. It sounded already as though there was a degree of backtracking on some of that.
Yeah, and I think they're going to when the economy does start to recover, I think they're going to find a renewed focus from campaign groups and others on the issues facing first-time buyers and the housing market generally. And they've perhaps understandably slightly taken their eye off the ball at the moment. But I think this year could be, towards the end of this year, we could see that attention return, particularly if there are still difficulties in the mortgage market.
Let's now then go to outlook and think about what the world could look like at the end of 2021 in terms of prices and transactions. Clearly, we've got an enormous variety of views. I mean, this is the year in which the Bank of England fan chart seems to me to be fully applicable to the housing market. We've had some very high estimates for growth, not least from the Intermediary Mortgage Lenders Association. We've had some fairly pessimistic forecasts from OBR. How well you're going to, I think you've done a little a numbering in terms of how we did last year in terms of outturn, and then perhaps we could look ahead to this year.
Yeah, so I suppose the first thing to do is to, kind of, I don't do explicit forecasts of numbers, but I can perhaps, a little review of what I got right and wrong is perhaps the most honest way to start. And I think the thing I probably got wrong was I expected that when the market reopened that actually the market conditions would be dictated by low turnover. The thing I didn't expect was the big rebound in activity that we saw and a return. So a lot of my expectations were around a lower turnover market, but within that I could then see, there being the possibility of prices rising, but I didn't expect that to happen in a high turnover market. The thing that I think what we saw when the pandemic first began to feed through into economic forecasts and people began to understand the consequences of what might be happening back in March and April, there was understandably in some ways a big rush to immediately call for a house price crash, and particularly based on the fact that for the last 50 years, every time there's been a recession, there's been a house price crash. But when I looked at it first in April, although clearly there were massive downside risks, and we continued to warn about them throughout the year and as we do now, there wasn't to me the immediate triggers for a crash. The house prices nationally looked to be priced around about the level that you'd expect given wage levels and mortgage rates, and we had several conversations during the year where we were talking about the support that homeowners were getting in terms of the mortgage holidays, and the fact that lenders would be unwilling to repossess while the market was struggling. And so I think all of those factors meant that the house price forecast that was the house price crash that was forecast by quite a few people was never as guaranteed as they perhaps thought, and it felt like that perhaps some people were rushing to get ahead of the press story rather than actually thinking rationally about the market. And the final kind of reflection from me is one of the things I learned back in the previous recession was to when the data changes, you need to be pretty quick to change your understanding of the market and reflect the underlying market conditions. The mistake I made the previous time was trying to project what I hoped would happen to the market rather than what was happening, and so when we saw that initial activity really ramping up after the market reopened, it looked like there were still quite a lot of people who were perhaps fixated on their forecasts for crashes or weak growth, and so there was I think being flexible and able to rapidly kind of reassess what you thought was happening was quite important, and that seems to have perhaps fed through into the stamp duty holiday, and I think that's probably what we're going to continue to see this year. You mentioned the wide range of forecasts. I was having a look at the Treasury independent forecasters, and it's kind of plus 6% to minus 6% this year, and actually my personal view is probably it could easily be both. It could be both or somewhere in between. I think right now you can make a perfectly rational case for there being a boom towards the end of the year, as the vaccine begins to filter through, the economy reopens perhaps faster than some other parts of the world. And particularly if we see those distributional effects where we've got demand supported by wealthier and higher income people, we could continue to see the race for space driving through. But equally, on the other hand, there's clearly going to at some point be a reckoning of the economic impact, and people on furlough and people who have maybe companies and jobs that have they've been holding on in the hope that things get back to normal pretty quick. As this drags on, there are going to be unfortunately more and more people who have to effectively take the hit. They're either made redundant, close their company, and that will have an impact as rising unemployment.
It does feel like the year will have various different trajectories in it, that we may continue to see prices rise up until stamp duty holiday ends, assuming it does. Then we might have a period of flattening and potentially falling. And we were already seeing transactions slowing. There seems to be some anticipation building up of something happening in the spring. So prices then start to edge down in the spring, but then later on in the year, as you say, as some of the economy restarts more fully, we might see recovery again. The year will be made up of quite significant fluctuations and changes in direction.
Yeah, and perhaps more of interest to researchers and analysts like ourselves, you then end up with weird situations where the market might actually be seeing rising prices in Q4 of this year, but actually the price growth metrics are pretty weak because we've had quite a strong Q4 in 2020, and when you're looking at your annual change, it's not a lot, but actually it represents quite a strong market. So you're going to have these weird data quirks coming through as well that will add to the complexity and the challenge in assessing what's happening.
Yes, and trying to read annual from monthly is going to be quite difficult, isn't it?
Yes, definitely. And and I mentioned the ONS index and the fact that I think perhaps its November numbers will be revised. It may be that I think what will perhaps be most interesting, but also most challenging to look at is the local impact of what's happening in the housing market, and where is seeing house price growth, where's seeing house price falls, where's seeing rising turnover, where's seeing falling turnover. That is going to be a real challenge for this year, and
so a complex geography, a complex pattern through the year. We're probably neither of us arguing there's going to be a massive house price crash. We're certainly not arguing there's going to be a massive house price boom. I mean, there is a bit of bullish commentary around the real estate market where there's a certain frenzy amongst some about the markets marching ahead and will continue to march ahead. I don't think I'm with that.
I could see both a crash and a boom as a realistic probability of happening this year. It's not what I would expect. To be honest, what I probably expect to happen more is actually we'll see some places experiencing booms and some places seeing busts, and so I think and even within those places it could well be certain property types, an exaggeration of what we're seeing already with detached houses versus flats. We could have a crash in the London flat market this year, but actually the London house market continues to perform well, and so actually your London region, looking at all property types, is flat.
This is a good argument for analysts that what we'll have through the year will require a lot of granular data and a lot of granular analysis.
Yeah, I think that is probably the most likely outcome looking ahead. But I think perhaps the one lesson is that it's uncertain, and that uncertainty is going to continue throughout the year, and where things are looking rosier than they were, even a week or two ago. But
and 2022, for you, just really trying to be fully speculative, 2022 feels like a sort of chance that we may get back to some sort of stability, a rising trend in house prices and transactions.
I hope so. I hope my main hope for the year is that it's a full school year with my kids in school all the time. So that's my that's my priority for the year.
And you've had your injection by then.
Yeah. So it. I think in the absence of a crash, I think it's probably more of the same that we'd seen before the pandemic, of continue where lenders will be keen to grow their businesses. There will be concerns around certain markets. I think we will probably continue to see more activity in the house market than the flat markets, and that's both in the existing market and also the new build market. But it's hard to see some of the big forecasts for some people, some of the 5-year forecasts for house price growth. And I guess one of the big questions for me, the two absolutely key variables for house prices are wages and mortgage rates, and those two go a long way to determining what happens to house prices.
I think this is a good point, Neil, for you probably, to draw this to a close. I mean, we've worked our way through the drivers, through the consequences, through government assistance and forecasts. I mean, are there any final comments you'd like to make around that?
I guess the final conclusion is I honestly don't know what's going to happen this year, and I
totally agree.
I mean, you can obviously talk around a narrative around a particular idea of what might happen, but perhaps the only honest appraisal you can do is actually that there's a range of possible outcomes for what might happen, and certainly once we get past the stamp duty deadline, that might give us a bit more of an idea as to what will happen in the rest of the year.
So I think amen to that.
Thank you, Peter. It's a delight as always.